But right now, it's time to welcome our first guest, Gary Shilling. Gary Shilling is a financial analyst, author, and commentator whose work appears regularly in publications such as Forbes, the New York Times, and the Wall Street Journal. He's president of Gary Shilling and Company Incorporated and the editor of Gary Shilling's Insight. He's a featured guest on all the top financial shows, and of course, we're very pleased to have him with us today. Gary, welcome to the show.
Glad to be with you.
Hey, so tell us, how have you been putting this in perspective for your readers, your listeners, clients, all the market volatility this year, and I guess particularly the wee little bit of market volatility we've had so far this week?
Well, I think what looks like is happening is we're in the prelude to a recession. As a matter of fact, in our November issue of our monthly newsletter, Insight, I listed 13 pre-recession indicators. I might just mention very, very briefly. Output exceeds capacity. That's what the numbers show, and that's typical going into recession. Stocks are falling. They're a leading indicator. Central banks are tightening. They always do and end up precipitating a recession. Yield curve, I know we're going to talk about that. That's near inversion, and that's always been, when it does, it's always had a recession. Junk bond, treasury spread is opening. Another indication people are worried about weak credits. Housing activity declines. Housing is very interest rate sensitive, and when the Fed raises rates, it's the first major sector of the economy to decline, and it is. Corporate profits growth is falling. We're coming off of tax cut effects, and earnings are tougher to come by with rising wages. Consumers are optimistic. They always are at the peak. Peak, as a matter of fact, that's the peak in consumer optimism. Global lending indicators are dropping. You look at OECD measures, others, they are uniformly falling. Commodity prices decline. Again, that's an early indicator. Things that we have in our portfolios,
Sure.
Copper and oil, they're declining. Data revisions, that's always happens at peaks. When they get more data and things are falling, the data revisions are down and troughs are up, but now they're coming in down. Emerging market troubles mount. We've written a lot about that. And finally, of course, we got the U.S.-China trade war, which is escalating. So all those things,
Wow.
There's nothing that says definitely in a recession, but there's a lot of indicators that we're headed that way.
So it's funny, I didn't think you were going to get to the U.S. trade war, and I was going to find humor in that on the fact that I agree that's not the biggest factor. That probably should be near the end. But yet the media is putting so much pressure. They're always talking about this. Every time there's a tweet or an issue, it's always about the trade war. But you seem to agree with me that that's not the biggest indicator. There's lots of other issues out there that are causing it.
List those in particular order. I'm not smart enough to have that kind of discernment. I think they're all important.
Okay. So the flattening yield curve. Now, I had Mohamed Alarian on the show a while ago who said, well, this time I'm not worried about the flattening yield curve, because when a flattening yield curve happens organically because there's not enough GDP to put the long end interest rates, make them higher, then when the flattening yield curve, when the long end is being held down artificially by low interest rates in Europe, then it shouldn't be an indicator anymore of a recession. So he wasn't concerned about a flat yield curve. Your thoughts?
You know, Sir John Templeton said the most dangerous part is different. All you can say is that every time the yield curve is inverted in the post-World War II period, you've had a recession. Now, those are statistics. They aren't indicate causality. But what it does tell you is that the Fed is raising rates, pushing up short rates. But on the long end, you're not getting nearly the spillover effect, in part because you never do. The further you get out on the yield curve, the less the spillover from Fed action is. But also, it means that investors are looking ahead and they're saying, wait a minute, maybe the economy is going to be a little softer, and as a result, interest rates are not going to go up, they may go down. And in this case, we think that there are strong deflationary forces in the world which will push them down. So,
and I agree.
In our portfolio,
I agree, Gary, with one thing you said, that the Federal Reserve often bumps rates up too high and actually create the next recession. And I think that's one of the bigger factors. So we need to leave it there for this segment. We'll be right back in a moment. But now it's time to welcome back Dr. Gary Shilling. So, Gary, it's interesting. We didn't dive into it all, but during the commercial break, you made a comment to me that with all the volatility in the markets over the last week or so, that it's actually been good for your firm and actually been profitable for some of your clients. Tell us just briefly about your philosophy and what you've been able to do to make money while it seems like everyone else has been losing money over the last week or two.
Well, we start with the political spheres, financial. We develop a forecast and then see what investment themes drop out. And we don't care whether it's long or short stocks, bonds, currencies, commodities, whatever. But I'll tell you what our portfolio has been recently, and it's been working very well. We're short stocks, U.S. stocks, and we do this mainly through indices. We're not stock pickers. We're short emerging market stocks. They're in trouble. We're also short commodities, copper and oil, and we're long the dollar, and we're long some 30-year Treasury bonds because that's I think deflation is now being more discussed, and also it's a safe haven.
Yeah, so you're not concerned about interest rates going up any further. I personally think the 3.25 on the 10-year might be the highest we see for a while, and if you own 30-year Treasuries, it sounds like you're in line with that.
Well, I can't tell you where it's going to be next week, but I think that we probably are going to, if we look out any length of time, 3-6 months, we're going to see interest rates distinctly lower. I mean, again, the dollar is a safe haven. You've got foreigners. They have a huge advantage in being in dollars. Our interest rates are higher than they are in most developed countries. There's this whole Trump trade war. Hey, whether you like it or not, it's gaining a lot more respect for the U.S. and where do people go when things are in trouble? Even if we start to trouble,
so Gary,
they go to the dollar and Treasury.
So Gary, tell us then what's different? Have the rules changed for the average investor, and if so, how?
No, they haven't changed. I think we've had a very, very long run. Stocks started rallying in March of 2009. You've had a huge run, and I think the biggest risk right now is complacency. In other words, people have gotten so used to relatively low interest rates, to a stock market that just kept going up, 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 and they've moved further out on the risk curve. People have chased yield. They want returns. They've gone into hedge funds, leverage loans, private equity, et cetera, commodities, emerging market. They're taking a lot more risk than they think, and that may be the ultimate Achilles heel that gives us the guts of the next recession.
So in the 30 seconds we have left in this segment, tell our viewers or income generation members, those over the age of 50, what you think is the number one thing they need to know in order to protect themselves in the year or two ahead of us.
They need to take a much more cautious attitude than has worked for almost 10 years. And remember that cash can be king at certain times. If you don't want to be short, which has worked out very well for us recently, if you're a long-only investor, I'd have a lot of cash.
A man after my own heart. Long bonds, long cash, and short the stock market right now. Gary, we're out of time. Time flies. We're having fun. Thank you so much for being on the show. And you stay with us too. We'll be right back here with more on the Income Generation.